Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas, and I am thrilled to have with me today my two favorite market analysts of all time, Marianne and Pamela Aden of the wonderful, amazing Aden Forecast. Marianne and Pam, thank you so much for being with us today. It's great to see you both.
Oh, thank you. It's a pleasure to be here.
Well, I've looked forward to when I see you, usually in New Orleans at the annual New Orleans Investment Conference, and it's great to see you online, even though you're down in Costa Rica and I'm in Austin, Texas. So thanks again for joining us. And what I wanted to do is share with my my clients and prospects the great work that you do with the Aden Forecast. It's been 40 years longer that you've been doing this.
Yes.
And you've been great at analyzing the market. The reason I like what you do is you don't have a bias. You just look at the data and the data tells you what to interpret and how to report that on a monthly basis through the newsletter, correct?
Yes. That's pretty much, yeah.
Well, that's what we like. We like an unbiased opinion that's based on the facts. So I'm going to try and share my screen here so we can share with our watchers some of what y'all do. So let's see if we can do this. So this is your website, the Aden Forecast. And this is the homepage where people can go to subscribe.
Yes.
This is a copy of the latest issue, the June issue, and I love it when I can see this blue and white paper in my hands.
Oh, so kind.
It means it's 12 pages of some of the best information about currencies, bonds, commodities, gold and silver, and stocks that you're going to get anywhere. And this is the latest issue, the June issue that's been out for a couple weeks now. The everything rise is declining. Uh-oh, that doesn't sound very good. So let's talk a little bit about your methodology and what you do. So this is a page on the world stock markets. And the headline here is Bull Market Near Maturity. We were talking a little bit before we went on camera about how you see the current stock market. Marianne, would you tend to elaborate a little bit?
Well, for the past couple of months, you can see on this chart, which is the top chart is the price and the lower chart is one of our leading indicators, which we rely heavily on with those because they work so well. And this one is a leading indicator of the long-term trend. So the thing that's most outstanding about this, if you look at the lower chart, is that the leading indicator has shot up to a very historically overbought level. It's gone way too high, historically speaking. I think it's even higher than the 2000 peak if you go all the way back. And it's very, very, this is a strong sign that the bull market is indeed near maturity. Now, that doesn't mean the bull market in stocks is going to end next week or tomorrow, but it probably will in the next couple months, more or less. And it is a leading indicator after all. But what this tells us is that the market now is in dangerous territory, and in the sense of you don't want to be buying in at this point because we're probably near a top, and a top meaning something like what happened in 2000 or 2008. And so we will probably at some point before year end see the market start coming down. Another thing that's interesting is just this morning, in fact, I was reading another newsletter and they were pointing out that investors buying into the stock market, like the little guy and inexperienced investors, which traditionally they tend to buy in at the end of a bull market run. And right now that's at an all-time high, even more so than 2000. And the same with margin debt, which is people are borrowing extensively to buy stocks. That's soaring. And those are also signs that the market is near a top. Those are all red flags. And there's a lot of other ones too. But anyway, so that's what this chart is telling us.
Well, that's powerful.
Go ahead.
Go ahead, Pam. I'm sorry.
Well, I'd like to add it before we finish the transportations. See, the transportations really took off out of nowhere because it was always kind of a lagging lagging indice in the market. And it started rising sharply with copper just since like last November, last summer. And so this is what shot up more than any other indice, like more than NASDAQ kind of went sideways for a while, but now it's not. But these sectors have been popping up at different moments, and transportations moves with the global economy more. It moves when you see picking up like we did, and you saw copper taking off, the resource sector taking off. So they're now both coming down together. But this chart also says it could top for a while. And while now the NASDAQ that was up at this high level months ago came down and is now up at a new high. So this is kind of like popping different ones. So this takes a little time to see a major top coming.
Wow. Interesting. Well, this coincides with Dr. Stephen Sugarud's melt-up theory that we're near the melt-up, we're in the melt-up actually, and that we could see a major correction this year. So it'd be quite interesting to watch. One of the things I learned about how you do analysis was when we were all together at a money show in 2015 up in Dallas, and you showed a chart like this with the underlying 65-week moving average, which showed good times to get in and out of the bigger picture market so that you would avoid downturns and not miss extended rally. Do you care to elaborate on that a little bit, please?
Yes, we have since the beginning, 40 years ago, and we continue to do it. We were tuning at the time, what's the best moving average for each market? So we found that the 65-week moving average worked very well in identifying the major trend, because that's what we were always after. We say, how can we get like a major rise? We get the bulk of the major uptrend. This is what this was always our goal, and it still is to get that bulk, and those moving averages help you get that. So if you would just go by buying when it's above it, selling when it's below it, and there's a lot of other indicators, and there's correlations, and there's other things that influence that too. It's not just one, but it definitely is very helpful.
Well, that's why I love your analysis, because it's not just a chart, it's a lot of nuance that goes on underneath. And it's all proprietary data that you have developed over your long careers, which give these indicators or market intent. You can reveal that to people ahead of time, which is amazing. It's one of the reasons why I love your newsletter so much.
Oh, thank you,
yeah,
Dana.
thank you very much.
One thing I just wanted to point out too that's really interesting. A lot of people tend to think you either are a technician or a fundamentalist for analysis, but we try to combine both of them. We like to look at the charts because like this, they give us warnings and that, but we also then very much look at the fundamentals to see, well, what's happening in the world, or what could drive the market lower in this particular case. And of course, a slow economy would, but we don't yet know. And that's what's so interesting about it, is that many times you'll see the indicator tell you something's going to happen, but you don't know what will trigger the event. And that's really fascinating, because the reason why will always become obvious in time, but sometimes it's just not apparent right at the moment that you see the warning signs.
Right. Well, it's a classic sign of a market when a lot of the smaller investors chase after a market, which tends to create a euphoric market that everybody gets caught up in. It's emotional. And you take the emotion right out with your analysis, which is one of the reasons I love what you do.
Oh, well, thank you.
So with the 65-week moving average on this chart, you said when the trend line is above the average, the red line, the black line is above the red line. That means the market's stronger. And when the black line goes below the 65-week moving average, that's when it's weaker. And in this instance, you would have stayed in the longer term major trend, but you might have sidestepped a couple of the dips along the way, which, most people react at the top and the bottom exactly the wrong way.
Right.
Yes, that's true.
Perfect.
So basically, if the black line, which is the transportation average in this case, but this would apply to the Dow Industrials, NASDAQ, all of them. If it gets above that average, you want to stay with it for as long as it's above. Now, we kind of jumped the gun in our recent issue and told our investors to start lightening up on stocks, and because
Especially
the transportations for sure. But because we do see these warning signs. There's about 10 of them. And so we don't want to have to wait until it drops all the way down to the average. But if you're a long-term investor, that's perfectly fine. You can wait. And if it breaks below the average, you'd want to get out.
Right. It makes sense to take some profits along the way too. So you can
Right.
reallocate into other sectors when things do change.
Right.
Perfect.
That's where the correlations and the ratios come in very well to see the relative strength of each one versus the other.
Right now, I love it. I love it. Absolutely love it.
Thank you.
Here's a trend line for the 10-year Treasury yield. And the reason I use this is because I think that you made one of the most underrated calls so far this year after Treasury yields collapsed last summer into August at 55 basis points and then rallied all the way up to 1.7% in March and early April. You said that the 10-year Treasury yield would stall at 1.7%. And I looked at every financial website I could find in the world at that time, and every analyst was saying that 10-year Treasury yields were going to 2%. And this is one of the biggest markets in the world, and you called it perfectly, absolutely perfectly.
Well, thank you.
Well, yields have receded since then back to about 1.5%.
Right.
So again,
Yes, well,
go ahead.
oh, no, I was just going to say that the 10-year yield, when it rose back up, it was a lot to rise from almost like 0.5% up to 1.5% since the COVID. And so it was a big rise, but really you're looking at it like from practically nothing to very little. If we forget that 1.5% to 1.7% was the lows, the historical lows of the 10-year yield forever, for many years. When that was in 2010, 2015, that was the base of the extreme lows. And now it's the high of this extreme area. So this is a saying that it can't even get back into what used to be, not that many years ago,
Right.
an extremely low area. So this is why we see that the market is, there's really not much you can say like on the upside. Like if you got up to 3%, it would probably hurt so many. It would hurt so many reasons in the debt. It would, and that would just be the top side of the low side of the last, say, since the 1980s and before, like looking into the 60s. So this is like very extreme territory we're in, and people tend to forget that because it's reality, and it's been reality for a long time. But it really is extreme. We're in such an extreme situation.
Right. There's a whole generation of investors that have never seen rising interest rates.
I know.
Exactly.
It's true.
Right. And this is a classic example where previous support becomes resistance in the short term.
Yeah, this is exactly opposite that we remember back in 1980. We remember when there was double-digit rising inflation was strong, that the long yields were double-digit, and you could never imagine it ever being where it is today. Back in those days, it was like crazed. It was crazy. It lasted a while, and then it peaked, and then that was it. In fact, if you would have bought bonds when those days, and bought a 30-year bond, you would have got double-digit gains up until not too long ago. So that just shows you how interesting the markets can be for you.
Right. So we may be entering another period like that. Here's a more close-up chart of where you made your call and where the support and resistance lines are. The big red line is across the middle is 2%, which is the Fed's target for inflation. And obviously we're over that now, but the fact that you called the top when the whole world was calling for that green line to go all the way up to 2%, and it didn't. I mean, that's just an amazing call. And one of the reasons why I respect what you do so much.
Oh, thank you.
Yeah.
One thing I was going to just mention is that the reason we made that call, was because, again, going back to that leading indicator, it started to go down, and it was telling us that rates were near a medium-term low. A medium-term high. Bonds were at a low. So it told us that rates are probably going to start going down. And what this, like Pamela saying, this will probably be just some ongoing bottoming action that could stay down at these super low levels for quite a long time. So we don't know, but it did coincide with one of our indicators, which you showed on the previous chart, hitting an overbought, over like extreme area, which told us it had gone too far. Rates had gone too far, and 170 was probably all we were going to get for now. And that's how that came about.
Well, the rest of the world should be watching because you got it right and most everyone else got it exactly wrong. So thank you for that one.
Well, thank you.
Yeah, thank you.
That's true. So let's look at what we have next. Now, I've been following the inverse correlation of the 10-year Treasury yield to gold, and it was the most direct I've ever seen from last August when Treasury yields bottomed until May. And that's when you made your call, basically a little earlier in April, that the yield would peak. And since then, we've seen a breakdown in the correlation to gold. And it seems like the dollar has taken the driver's seat in the short term again over the inverse correlation to gold that it normally has, where Treasury yields tend to, it looks like they take over when the real yield gets negative. They like to drive the gold price more. That's what I'm seeing.
Yes.
I don't know what your thoughts are on that.
Oh, yes. When the Treasury yield, are you talking about the real rate, right?
The real yield, once you take the 10-year yield and just subtract inflation to get a
Yes,
real
Yes.
yield.
that's the real rate has just collapsed and it's way, way down there. And normally those, when the real rate is negative, as it is now, it's extremely negative, more than 3% negative. It usually is super, super bullish for gold, historically speaking, and I mean, always. So the fact that the real rate is so bombed out right now is something that's very, very strong, a strong fundamental for gold, and it should help fuel this rise that we see continuing in the years ahead in the gold price.
Right. I want to talk about that a little bit more, a little bit in a few moments. So let's go through a few other things in the short term. So here is the gold price chart in your latest June issue, and you've got some letters on the gold chart, which is on the top: D, A, B, C, D, A. I know what these means, but some people may not. Would you explain that, please?
Well, again, back in the 80s, we were, the 70s actually, we were analyzing gold up and down and around and seeing if there was any way we could identify intermediate moves. By intermediate moves, we mean like we saw that rise up to that peak. You can see C on the chart.
Mm-hmm.
That whole rise is an intermediate rise, and the decline from the C to D up on the chart is an intermediate decline. That's what we mean by intermediate, like from the August high to the March low. So this is what we have seen. This pattern repeats every time. We always wait for it not to quite repeat the same way. We're always on it, but it does. It's incredible how cyclical gold truly is in the big picture and in the intermediate picture. It really is. Like, this is what identifies. So we show this as our timing indicator. This helps us time when is a good time to get in and when is a good time to get out if you're an intermediate person, or if you want to lighten up and buy at a lower area. That's what this chart is designed for. So this is what we use it for. And also what's good that works with this is the 5 or the 15-week moving averages. When those are breaking during this rise of the intermediate rise, that's a sign of saying, oh, it's almost over, and either way. So the latest one was the peak that we recently saw a few weeks ago. And that was what we call an A rise. And A rises tend to be moderate. There tend to be a consolidation from the big decline of the D that you see on there. Mm-hmm. And this is usually what it is. It's normally not a big deal, but it can, in the worst case, test that low, which would be the March low. And so it's to be seen if it does. And but in the meantime, that blue line on there is a very important support for gold. So we'll see if that breaks a bit or if it's pretty much holds there. So that's what we're in right now. We're in a decline we call B, which is also moderate. It tends to be part of that consolidation part. So the A's, the C's and the D's are the big ones. the big rise and the big fall, and the other two are intermediates. So this is how we see it, that this B decline we're in now, we're looking that it's going to be entering in probably this summer sometime, a good intermediate low area to be picking up some bargains, and especially in the gold shares that have fallen a lot.
Right.
And so this is what we're seeing right this moment.
Yeah, so the B rise, I'm sorry, the A rise all the way to the left of the chart was gold breaking out over or hitting a top at 1370. Then we have a B decline and then a C rise all the way from 1370 all the way to 2070 rather. And then
Right.
a D decline, which is a bigger decline. And now we're in the earlier parts of the recovery, which is an A rise and a B decline.
Right.
Yeah, now this goes back to the 70s. We've been
Yeah.
watching this intermediate since then, and we have the tracings of all this. And so we see that sometimes there's a moment where, oh, what's going to happen next? And that's that you can see that the C rise was an unusual double top, and that's what you see on the lower indicator. That indicator is what calls the shots of this.
And
So-
what's interesting too, excuse me,
Mhm.
is just that, like Pam said, this goes back to the 70s, and this A, B, C, D pattern has been so consistent. We've probably seen it repeat easily, I don't know, 25 times. And the timing, so we keep all the history on it. So we keep track of what's the timing, for example, a B decline usually lasts about 1 to 3 months based on what they've done in the past. And it's amazing how consistent this pattern is.
Yeah, and they tend to decline so much between a range. So
Yeah.
this is what we always look at as our guide for that moment.
Wow, fantastic. And I love that you have data that goes all the way back to the 70s, which most people don't have today, and that you use the recurring patterns to try and anticipate and predict what's happening now.
Yeah.
It is. It's really
And
interesting.
also what's interesting is D declines tend to identify the new bear market when a bull market's underway. It usually starts with a D decline. And
Right,
so those are always watched carefully.
Yeah, the exciting part for me in this whole phase is that if we're in the B decline, which we obviously are, the C rise tends to be the most explosive. And
Right.
Yes,
that would be in front of us now.
but see, that's the whole thing. It's explosive in a bull market, not necessarily in a bear market. So in order for this bull market that's been underway since end of 2015, and it gained ground in 2018, for it to be still a solid rise within its pattern, on the next C rise, which should be in the fall, the last quarter of this year, if it rises above the August high, which is the record high, then it's just reconfirming a super solid bull market. So this is what we'll be watching for this from now till the end of the year.
Right.
Well, there's a lot of reasons why I think that you're going to be right on target with that. And that's a whole nother subject. So let's keep going. This is a gold chart that goes back 18 months, and it shows most of that, what would be the C rise in the top. And
Right.
now the D
Right.
decline, double bottom at 1678,
Yes.
the A rise back up to 1900, and the B decline, which we're not quite sure where it's going to bottom yet. We may.
Right.
1730 is kind of what we're looking at, but in the worst case, it's 1678 back at that low.
Yeah, the double bottom. Okay, good.
Right.
Good. Interesting. So here's gold in a bigger picture. So what you're saying is if the pattern holds, we'll move back over 1900, and then perhaps previous resistance will become support, and gold could easily march into the $2,200 to $2,500 range.
Right.
Yeah, I don't know if it would do it this time around, like looking at this upcoming C rise, but if it did, it would be incredible.
I think it will.
Yeah, well, it might.
Yeah, because it's got everything, the momentum is there, and it really just, every C rise, it usually, we are at a bull market, every C rise does hit new highs. So I'm looking that it will break the old high.
Yeah, and so what we want to do for investors is to buy during this low time, this time and there's still a bit more low side to happen over the next few months. And that would be the time to be picking up what you want, the gold, silver, physical. And it looks like short term, we could see gold outperform silver, but basically in the bigger picture, silver has the bigger hand for better percentage gains in the whole bull market. So
Yeah.
we would buy both.
Yeah.
And we buy silver shares and gold shares too.
Yeah, I agree with you both that silver has some more potential than gold, but gold tends to be leading.
Right.
Yeah, so very interesting. So here's silver. Here's a chart from your latest June edition of the Aden Forecast talking about silver's big steps. And you've got a resistance level, which looks to me like it's 27.50 or 28 there to the top that silver has been pressing up against, hasn't yet to break over. And again, you've got the 65-week moving average underneath this,
Right.
which would have worked perfectly for silver speculators back in 2012 and 13 when we went into a big correction.
Yes.
Then we went sideways for 5 years. And when silver finally broke out, it broke out with a vengeance.
Yes.
And as you know, Dana, silver tends to be a sleeper, which is what it was doing in 2015 to till 2020 at the low. That was $12 almost on March 2020.
Yeah, that was
And
crazy.
And that's when it finally woke up as last summer only. So it's pretty new. The bull market is only now catching up. So we're pretty excited about silver. Was so bombed out, and that sideways action is now over. It woke up, as you say.
No, and that's typical too in bull markets, that silver is kind of mellow. It doesn't do much, and then when it takes off, it goes crazy, and then strongly outperforms gold. And that's what we're thinking is going to happen again.
Right, I agree. In the bigger picture, silver tends to lag, and when it plays catch up, it plays catch up pretty hard. And
Right.
Yeah.
at basis the price of gold at near record highs, silver is only about half of its previous two highs of 1980 and 2011
Yes.
at $50 an ounce. In this market, I think silver should be $35 at a minimum, not 26 or 27,
Right.
about where it's at. So that's why I think silver is undervalued, just using that most basic measurement.
Yeah, like we're looking at once it can break 30, then we're looking at 35. That would be normal to see a nice $5 rise there.
Yeah, and this is a shorter term silver chart just for 1 year. You can see at very left bottom, it was under $18 forever. And when it finally broke up, it took off like a rocket.
Yeah.
It's been very choppy
That was
since then.
Yes, that was very exciting.
But the fact that the price action tends to be above 26 now instead of below 26 leads me to believe that we're about ready to take that next step higher, which is something that you agree on.
Yes, we do.
Yeah, it could still go a little bit lower. We have to see, but it's there. It's getting there.
Right. We could have one more retest of a low, like gold could drag it down a little bit if gold breaks and retest that 1678 double bottom.
And
Mark.
copper too. If copper has more downside, and if they both have downside, then silver could get hurt more.
Interesting.
Short term.
Because
Yeah.
copper's a leading economic indicator around the world.
Yes.
Yes.
Yeah.
Yes, it's the global. It's the poster child of the resource sector.
Right. Perfect. So here's a bigger picture chart of silver, and you can see, I've got two lines that go across, one at 21 and then one at 28, and silver's in the middle of that range, but most of the time it's either below 21 or above 28. And looks like we might be ready to take that next step, as you said. So I think
we look forward to seeing how that happens.
Yeah.
right. It'll be interesting. And I'll be reading my issues when they come out every month. Plus, I forgot to mention, you put out weekly updates in the meantime, which keep people apprised of the bigger moves in the short term on a weekly basis with a weekly email update.
Right.
Yes.
We do. We kind of update what's in the monthly issue on a weekly basis in case there's any changes or any actions that need to be taken, or new buys or sells or changes in the markets or anything like that. So we do that every week.
When do you ever rest?
All the time. Especially this past year, we've had plenty of time to rest.
Well, that's good, because it's going to be more interesting as time passes.
Right, right.
So here's a page that you do, you talk about currencies, you measure the dollar against all the other major world currencies. And here's another look at how you analyze charts. You've got a major uptrend on this chart, and then you have a oversold and overbought area. I think I have a close up of this particular chart. Let's see. And there it is. This is where the dollar is now. It's been channeling between about 88 and 95 on the dollar index of late.
Right.
And what are your comments on the dollar right now? Because this is obviously one of the biggest impacts on gold, inverse relationship to the dollar.
Well, you can see that last January, you can see how the indicator fell to a low area. This is a long-term indicator, and well, longer term. There's longer ones than this. This is kind of between medium and long, and this one is starting to rise from the lows. So it doesn't do that very often, as you can see. So this is telling us that we could have a decent rise in the dollar index, like right now as it's developing, and it could go higher for several months. So this is what, maybe even longer. So this is what we're watching, that it's holding at that 2018 low and also that uptrend. So that's good. That's a key support area. That's why we call it the crossroads, because if it falls below that 2018, then it's all off. It's still going lower. But if it holds, and that's what it looks like it's doing, and starts to rise from there, which it's doing, we're looking at that blue line. If it breaks that, then we could even see, in a best case scenario for the dollar, would be to test the old highs, the 2020 and 2016 highs. That would be like around 100. That sounds like from 95 to 100. We're seeing 95 could happen now, and but to see 100 would be, that's still to be seen.
Yeah, the dollar would be pretty strong over 95 is what you're saying. And that is about where the 40-month moving average is right now. That's how you come up with 95?
Yes.
I see. Yeah,
But then I just wanted to add, keep in mind, we're talking like maybe in the next couple months, this is a possibility, because as you know, long term, the dollar has been in a 50-year decline. So it's a big long-term mega downtrend, but within that downtrend, it has periods where it'll rebound and move up a bit. And that's what we're looking at here when we look at this closer up picture.
Yes, but in that downtrend, it can have a nice rise. Like now, in the big picture, from where it is now to 9,500 would not even be a big deal. So that's what we're zeroing in on right now.
Well, I love the how you're so unimpassioned about, what the numbers tell you. It's so, there's no bias. So that's why I love when you put out your analysis, because you, as I like to say, you don't have a dog in the hunt. You just want to call the markets.
That's true.
And so here's a chart of the dollar going back 3 years. And I've got the 95 level marked here in the middle with the upside resistance at 99 and lower support at 90.5, but really you have support at 88, I believe.
Yes, the lows there.
So we could run all the way up to 95 and still be in a bear market for the dollar, but just near the top of a short-term cycle.
Right.
That's right.
Right. And Marianne and I talked just a moment about the fact that the dollar could be a little stronger right now because Europe and Asia are experiencing the D variant of the COVID virus, which is potentially making some economic closures over there happen, which aren't happening here. So the US is a bit more of a safe haven. And as we've seen over time, when things happen, people can go into the dollar and into US treasuries with foreign money, and they've got to get into the dollar first to do that. And that tends to buoy the dollar. So, whether this is because we're having a good economy or maybe we're just better off otherwise with COVID, it's hard to say, but that's why I like your technical analysis. You take some of the bias down.
It's interesting you say that, because just last night I saw on the news that they're expecting the variant to pick up more steam in the US, and it is, it's already there,
in all states.
And so we'll see. I mean, maybe that's going to be the factor that triggers the decline in stocks. It's still to be seen, but you mentioned that, the dollar's looking a little more attractive because the variant's in Europe now. So we'll have to see, but it's all really fascinating how everything kind of ends up linking together, you know?
And also I'd like to add that it just so happens in today's Wall Street Journal online is saying that Europe is now starting to look better than the US as far as COVID goes. This was like something new, a new article. So it's flip-flopping back and forth. So it definitely is probably what the bond market is telling us, that by rising a little bit is telling us maybe we're going to see some slowdown news come up.
Well, time will tell. That's why I'm always, fascinated by being in the precious metals markets, because everything affects them, whether it's economy,
Right.
politics, economics, currencies, there's always something that's going to happen. And I love current events too. So
Yes,
Yes.
exactly. We do too.
Yeah, we love it.
it's never a dull moment.
No.
That's for sure.
So here's a bigger picture look at the dollar. Back in the early 2000s, the dollar was very strong. Then as we went to war and it got into deficit spending, the dollar went on a big decline. It bottomed, at 72 on the dollar index and stayed there after the financial crisis. When we gained economic traction first in the post 2008 financial recovery, the dollar took off and got back into the higher trading range where it's been for the last 4 or 5 years. So basically between 88 and 104 on the dollar index is normal trading range. Above 95 is strong, below 95 is weak. And we just have to see whether the dollar can move above 95 or below 88 in the medium term.
Right. That's right.
Yeah. So this is how I look at it. I don't have a lot of the nuanced tools that you use, which is why, again, I defer to what you all have to say, because you're obviously much more intelligent on these things than I am.
No, not at all. This is a great chart. I
No,
like
but
it.
we're in agreement looking at it different ways, but it's great. But those are the important numbers to watch. Yeah.
Well, thank you. You're being kind and I appreciate it.
No, it's real.
So here's really where I'm really curious as to what you think about everything that we're in right now, because we have inflation is hotter than it's been since the 70s. We had a bout of inflation in 2007 and 8 that waned on the back of the financial crisis. Now we're going through one of the strongest bouts we've seen in our lifetimes since the 70s. There's a lot of calls for much stronger inflation over the next couple of years. This chart is a real 10-year Treasury bond yield chart once you subtract inflation from the bond yields. And in my opinion, one of the largest or biggest drivers of gold to record highs in 2011 and 2020 were the negative real yields. Once you factor in what you can get out on a return, for example, a 10-year Treasury against inflation, once you subtract inflation. The real yield was at an extreme negative in the fall of 2011 and again in the summer of 2020. And that's when gold set record highs. And today it's off the charts, yet gold is underperforming. So I'm a little confused by this. There's all the talk of the inflation being transitory, but I see reasons why inflation could get some traction. I see reasons why the US economy that's enjoying a lot of great GDP growth this year could wane next year. We have too much debt and that's a burden. So in the current market, what are your thoughts on inflation and where you think it'll be in a year or two from now, if you can look out that far? And do you have some thoughts on why gold may be underperforming right now relative to inflation? And more importantly, what can Treasury yields really do without harming the economy in the short term or the long term? I know it's a big question, but this is the bigger picture. And this is one of the reasons I wanted to talk to you today, to see what your thoughts were on this.
Well, as far as this, we were talking about this earlier, this collapse in real rates is very, very bullish for gold. And we think, gold hasn't reacted yet on the upside, but we think it will. We think it's just a matter of time that real rates are going to push gold up and trigger the up move. And now, as far as how long can this continue, there's pros and cons. Like inflation is up big time so far this year, but then a lot of people are thinking it can't keep going because it's the economy just isn't going to allow that because it is burdened with so much debt. So that's still to be seen. We have to see how much the economy can grow under this debt burden that it's currently living under. So that's to be seen. And I think, Dana, you had mentioned that, you know, once you get debt over 100% of GDP, the economy just isn't, it's like it keeps a lid on the economy, which is what we saw and we've seen for the past 20 years in Japan. And so the US, you know, could be following Japan. Many people very much believe that to be the case. And if so, then we're never going to get that booming growth. And so the question is, if we don't get the booming growth, can inflation boom? And so it's all to be seen. It's going to be really interesting to see how this plays out. But in either case, we think with these low real rates, and we think they could probably stay low for quite some time, that is going to keep a real good foundation under the gold price.
Yes, and then it's important to see what inflation does next year and compare it to this year. Because right now, inflation on an annual basis is comparing it to last year's horrible numbers. So next year will give us a better balance on where inflation is really headed. But yeah, maybe it's going to rise, but we don't see screaming inflation just yet.
Yeah, the way I see it, I think we're heading into a period of stagflation where we'll have low growth and moderate inflation going forward, and we'll enter into a period like Japan has been in for 30 years or so now.
Right.
When an economy carries 100% of debt to GDP for 5 years or longer, it's impossible for that economy to grow at more than 3% a year because of the debt burden. Channels, you know, money that would go to grow the economy towards things such as research and development or infrastructure goes to debt service instead. And we've been there for 5 years, and now our debt is exploding, and we're at 135% of debt to GDP on official measurements, let alone, you know, the other things, entitlement spending, which conceivably make that much higher. And, you know, we are going through a low base inflation from last year. You're right, Pam. So the numbers are a little bit skewed, but still, lumber is twice as much as it was a year ago. It was 4 times as much, you know, a couple months ago. It's come down.
Right.
Copper's still up, right? Oil's still up. So we'll have to see, you know, what the markets will bear. But our debt has fundamentally exploded, and
yes,
it has, and it looks like it's going to keep exploding with all the spending that's still to come. So
yeah,
and it's interesting to talking about Japan. They're by far of any country the one that has the biggest debt to GDP ratio. I think don't quote me on this, but I think it's well over 250% or something like that. So,
right,
you know,
it is
with
about
our new spending, I mean, if we get up to anywhere near where Japan is, then, you know, again, you can say, yeah, we probably will continue following Japan.
Yeah, I think the best encapsulation of what I heard anyone say was George Gammon. I was at a seminar a couple of weeks ago where he was there, and he said the only real release valve that this whole equation has is the dollar. So I think, you know, if we don't see rip snorting 1970 style inflation, we still could have moderate inflation, but the consequence of the debt and a weak economy will be a weaker dollar, which will ultimately be good for gold.
Exactly.
You know, we may not get the stellar strong runs in gold like we had from 1375 all the way to 2070, but I think we could see a real grind higher over time, especially as the dollar continues to lose purchasing power. I think that's
absolutely.
No, like maybe grind for the next couple of years, but after that, we see that there's a much better potential to have a great rise.
Well, time will tell. And,
yes,
you know, I will look forward to getting your monthly newsletter and your weekly updates. And that's what I wanted to talk to you about today. I really, really appreciate the time that you spent with us. And I would highly encourage anyone who's watching this to subscribe to the Aden Forecast, which is one of the best monthly publications you're ever going to get for the money. And you've got 2 of the best analysts you're ever going to have supporting the cause
Thank you.
Well, thank
your
you.
intelligence. Yeah. So no, you're welcome. Thank you for the work that you do. And it's been a pleasure to know you as colleagues and also as friends. So
Yes.
Very much so, Dana. And I just want, in closing, I just wanted to add one thing that we didn't mention. And I think it's a kind of a positive note for gold to end on, is that if this bull market ends up being similar to the last two bull markets, gold has the potential to rise up into the many thousands of dollars ultimately when it hits its peak. So that's something that we're looking at for the long term. And we didn't mention that, but I did want to point that out. So it is something that's probably very exciting coming up in the years ahead.
well, if gold goes up in multi-thousands, there's be a lot of problems elsewhere, you know.
Well, that's true.
Yeah.
So that's a double-edged sword, but you know, I've reconciled myself that gold climbs a wall of worry, and you know, that's just the life we live in when you're in the gold business. So
It's true.
Right.
but it's the best preserver of wealth that anyone is going to have, in silver too. So
Absolutely.
It's the best. It's really the only one.
well,
Oh, and we might want to add about we didn't go into the infrastructure plan of Joe Biden, and we think that's going to be phenomenal for the already bull market in the resource sector. Like you said, lumber and all the resource sector has a really good future ahead.
well,
And that also makes it the whole commodity, gold, precious metals, and commodities in general.
will you be making specific recommendations in the newsletter?
Yes.
Right, how to harness the power of that infrastructure plan if it unfolds, which it looks like it's going to. So I'll be looking forward to your recommendations there as well.
Okay.
Okay.
Well, thank you.
Yeah, thank you
It's
so
been
much,
a real
Dana.
pleasure.
Very much a pleasure.
Thank you for your time, and I'll look forward to seeing you at the New Orleans Investment Conference in person
Yes,
Okay,
we'll
for
look forward
sure.
to it.
in October. Yes. All right. Thank you so much again, Mary Ann,
Thank you.
and have a great day.
And
You
you too.
too.
Thank you
Thank
very
you.
much.
Bye-bye.
Bye.
Bye.